Welcome to this weekly update. I'm Julia Lee, an equity strategist with Bell Direct. And this week has been one where we've seen the Australian market coming under pressure, in particular the telecom sector underperforming, with Telstra shares hitting a 52-week low. On the flip side though, utilities have outperformed, gaining more than 2%. So starting off with Goldman Sachs, which is looking at charting the path for Australian equities. And this chart showing 3-month earnings expectations. You can see that earnings expectations for the cyclical space has been rising, while earnings expectations for the defensive area has been falling. But overall, the market earnings per share expectations has been on the rise. So I guess looking into 2017, that means overweight the cyclical sector, underweight the defensives, and overall positive the market. Having a look at some of those bond proxies that have been under pressure over the last 12 months, and Goldman Sachs still saying that those bond proxies are looking around about 8% overvalued in comparison to the 10-year US bond yields. So still an underperform for those bond proxies. The exception might be Telstra, where Goldman Sachs says that it does see value emerging. Having a look at some of its other stock calls, and in the retailing space, it likes Wesfarmers as a buy, saying that the valuation gap between Wesfarmers and Woolies is the highest that it's been since the global financial crisis. Also, just having a look at some of the supply constraints and what stocks that may be positive for, and it's positive on Alumina, South32, Rio Tinto, as well as BlueScope Steel. This week we've seen some stats on US housing which have been quite positive. We've seen US housing starts for February up 3.6% compared to the previous corresponding period, and new home sales at a 7-month high with a rise of 6.1%. Or it's focusing in on some of those stocks exposed to US housing. It has Boral as an accumulate. Meanwhile, it has James Hardie as well as CSR as a hold. Retailers have been under pressure, and Credit Suisse out with a report this week on the impact of Amazon on Australian retail, saying that Amazon customers are mainly very heavily weighted towards things like electrical, home, sporting goods, clothing, as well as children toys. Big, bulky items have less of an impact because of the postage charges, and it sees that high-risk stocks like Myer. Premier Investments, though, buffered a little bit by a Smiggle Business, ex-Australia, and Harvey Norman also buffered because of the bulky nature of a lot of the goods that it sells. It's done a sensitivity analysis, and on the high impact side, this is where market share contracts in line with store activity. On the low impact side, this is where companies are winners in retail consolidation. But overall, you can see that the big loser is Myer, followed by JB Hi-Fi as well as Super Retail, and to a smaller extent, Premier Investments as well as Harvey Norman. Oil prices this week have taken a bit of a tumble, losing at least 2%. Deutsche Bank concentrating on some of those oil stocks. It still has a buy on Oil Search, Santos, as well as Caltex. And now moving on from oil to Macquarie, which is looking at infrastructure, saying that it still likes infrastructure. What it is seeing is an improved funding situation for infrastructure from the states, shifts in electoral momentum, as well as progress in planning. And some of those infrastructure stocks that it prefers include Adelaide Brighton, CIMIC, Lendlease, as well as Transurban. And finally, an interesting piece from Wilson looking at the impact of directors buying and selling and how the share price performs. In particular, just having a look at the period from November 2016 to March 2017 and the impact on the share price after the results. So looking at the direct purchase of shares in the 90 days ahead of a company's result this February earnings season, and actually if directors have been buying, it's had a positive impact, outperforming the market by 5.8%. As you'd expect, if directors have sold in that 90-day period ahead of the results, it has a much more negative effect. So underperforming the market by 5.6%. If you put a filter on it and those directors with a stake of more than 5% in the company selling some of their shares in that 90-day period before results, then underperformance of that company's share price by 9.7% after their results. So altogether, it looks like insider buying and selling, or directors buying and selling, impacting on the company's share prices, and also could be a signal of confidence of the company's outlook. So looks like the market's still struggling to get above 5,800 points. In focus very much next week is whether Donald Trump is able to repeal Obamacare through the House of Reps. I hope you've enjoyed this weekly update.